In this video, I'm going to be showing you why I absolutely love trading indices. And what you're looking at here on the screen is my results trading them on one of my brokerage accounts for the last few years. The indices are my absolute favorite things of all things to trade. And in this video, I'm going to be going over the pros and some of the cons that you should be aware of before getting involved in trading indices. Again, this is one of my favorite topics to go over, so I hope you get a lot of value, and do hit that thumbs up button and subscribe if you're new. Let's jump in. All right, guys, so we are here taking a look at tradingview.com, which is where I personally do a lot of my analysis. And in this video, like I said, we're going to be talking heavily about how to trade indices like a pro. And first of all, we need to know exactly what we're talking about when it comes to indices. The main ones that I am referring to here, at least the ones that I trade the most, are going to be the US indices. Now, you should know when I say indice, what I'm referring to is, of course, it is essentially a basket of stocks, right? Here is, we're gonna make a magical basket. Thanks to the power of video editing, a magical basket is going to show up on the screen right now. So indices are basically a collection or a basket of stocks. Now you have all sorts of different baskets that you can take a look at. So for example, US 30 may be considered one of our more value-oriented baskets. This is going to have big, huge, stable growth companies in the United States, mostly things like Coca-Cola and Walmart, right? These are your big, stable companies. Then you have the S&P 500, which is a broad range of stocks, but it encompasses the 500 biggest US companies. Of course, this is going to give you a lot of diversification. It's also going to give you some big powerhouse companies, while some smaller ones also mixed in as well. And finally, we have the NASDAQ, or the NAS 100. The NASDAQ is comprised of a lot of tech and finance companies, but there is a wide range of company sizes here. One thing that separates the NASDAQ from the other two is that it is a little bit more volatile because it oftentimes does encompass a wider range. Now, again, we're not taking a look at just the 30 huge companies or 500 huge companies, right? This has a range of different sized companies. And so the NASDAQ of the three is going to be the most volatile, and the US 30 is usually going to be the least volatile. And finally, the S&P 500 is going to be somewhere in between. Now, I can already hear people who are saying, hey, US 30 is way more volatile than NAS 100 or SPX 500. Now, I can understand where you're coming from. Some people who are watching this video are predominantly Forex broker traders, meaning they trade on a foreign exchange brokerage. And I should just go ahead and say that if you are trading on a Forex broker, these things are going to be different because US 30 has the largest size compared to the NASDAQ, which has the second biggest price tag. And of course, the S&P has the smallest. In Forex brokerages, what they do is their contract sizes are very, very large. So US 30 ends up being actually the most volatile, even on something like a 0.01 lot size. Now, if you're not a Forex broker, if you're trading on the futures market or ETFs like I do, then of course, you may not need to worry about that so much. But just know that in terms of actual daily volatility, the US 30 actually has the least. I'll show you that now. Okay, so now we're taking a look at a weekly chart, and I want to show you guys something just to show you how volatile the NASDAQ is compared to the other two. So during the 2020 run-up, we saw the NASDAQ go absolutely crazy, but it was followed by, of course, the huge sell-off that we saw in the market following, again, the inflationary problems that we had from the Federal Reserve. And of course, we saw the rate hikes kind of come in heavy. Well, anyways, let's take a look at something here. I'm going to measure this move from the top to the bottom of the sell-off. And you can see that there was a decline of 37.83%, which is massive. And if we compare that to, for example, the S&P 500, which also saw a big dip, you can notice that on a percentage basis, this one is much better off, only down 27.63%. Still a nasty drop, but not as bad as that 37.38 that the NASDAQ saw. And finally, the Dow was the least volatile of the three. You can see in this case down only 22.66%. Again, a significant drop, but not nearly as much as the NASDAQ. Now, of course, this goes the same thing on the upside. So in this case, the Dow or the US 30 here is up about 23.45%, but the NASDAQ comparatively from the lows is up a whopping at the most 52%. So you can see there's a big difference here in volatility. So how do we actually trade them and how can we take advantage of these moves? The first thing you need to know when it comes to indices, at least how I trade them, I want to talk about some of the biggest pros I think there are when it comes to the indices. The indices have incredibly good trending environments. You can see it doesn't take a genius to understand that if you were buying dips in this run up, you were probably making money, right? It's actually kind of hard to mess this up if you are trading as a swing trader or something like that, pullbacks in this market, which is of course how I've been able to generate those results that you saw at the beginning of the video. I've had a really good trading year so far in 2023, trading almost exclusively NAS and S&P 500 pullbacks intraday as well as on a swing trading basis. So I've been mostly on the long side. So my point here is the biggest pro that I have personally with the indices is they tend to trend very well compared to some of the other things that are out there, for example, currency pairs, etc. Gold can also have these, but gold tends to have more rapid trends in one direction, more quick falls or quick rises, at least from my studies that I've done on these things. We could take a look again, same story on the S&P 500. This market has rallied and trend following has worked very well. Now, again, you could even reverse that and say, well, last year there was also some beautiful sell side opportunity trends. If you're somebody who looks to short in a downtrends kind of thing, there are these beautiful opportunities. And again, as a momentum trader, I think the indices are certainly a great thing to consider looking into, because again, they do carry, of course, there are cons that we're going to talk about, but they are also, very, very much great trend following opportunities. Same thing, of course, with the Dow. Not as much of a clear trend recently, but still, you can kind of see on the longer term basis, there are beautiful uptrends and downtrends to take advantage of. And if you caught some of that 2020 sell-off, I was unfortunately on the wrong side of some of this, believe it or not. It ended up being fine in the end, but again, tough times can occur. And this brings me to the major con of the indices. There are periods of time where if you were building a sort of a long oriented strategy, which is what I personally do, generally speaking, I am more poised or biased to the long side on indices. Indices have a characteristic that we need to talk about before I talk about the con. They have a characteristic where they tend to rise slowly and drop quickly. Rise slowly, drop quickly. Rise slowly, drop quickly, right? This is a pro and a con, but we need to address the cons here. There are big risks associated to trying to trade indices. When those crashes come, they can be nasty, right? They can be very, very sudden and very, very heavy, right? So for example, let's scroll out on this and we could take a look at some of the crashes, quote unquote, that we've seen in recent stock market history. Huge move in 2020. 2018 was a big drop. We also saw, this was 2019, 2018, 2019. We saw some sideways and quick dips. We also saw some tough times in 2015. Right, so some rapid drops. And again, this can expose you to a lot of risk if you're not careful. So in terms of trading the indices, these are all things that you need to know before we start getting into shorter term technical strategies. Because I know some of you guys are like, well, Nick, I don't trade the daily chart. Maybe you're trading the 15-minute or the 5-minute chart. But you need to know the inherent risks, pros and cons when it comes to trading these things before we get involved. So what next? How do we trade this thing? Well, again, my personal tip would be pay close attention to the trend. If the market is trending very, very strong to the upside, do not be the one fighting that trend. Because if you scroll out, if you were one of the people that has been fighting the trend in 2023, it's been a very tough time for you. Now, again, same can be said if you're fighting the downtrend, which, let me be very transparent, this was kind of me. I caught some really great moves in 2021 and 2020 in my trading performance, but during this, I caught some of the downside, meaning I was still bullish, and of course, the trend ended, and I caught some losses on that trend. Again, nobody trades perfectly. Nothing is that easy all the time, but again, you kind of have to take the goods and the bads when it comes to trading indices. Again, crawls up, rapid falls. Now, Some traders actually love to trade these sorts of events. When the market starts to sell off, they heavily look to short the market, take advantage of these drops. That is not my style personally. I'm usually more interested in trading these movements and trying to capture sort of shorter term swing trades. But again, my major tip for trading the indices would be trade in the direction of what the trend is truly doing. So how do you define the trend? Well, you can do it in a number of ways. For example, some traders might use simple Bollinger Bands and say as long as we are above the simple moving average, but we are not above the upper bands, this can be a beautiful way to identify possible pullbacks where you say, okay, I'm looking for a pullback to the center line and I'm looking to not take trades if we're above this sort of thing. That could be a simple indicator. Again, what I love about the indices so much is that oftentimes simple indicators can catch beautiful trends. So for example, if you are adding on to your chart, a moving average, right? Simple moving averages can actually do wonders. One really popular one is just applying a simple 200-day moving average to your chart. I can't tell you how many professional money managers I've actually spoken with on my podcast episodes, and they acknowledge the 200-day moving average is a very important indicator in their trading. So when the market is underneath the 200-day moving average, they are not buying, and they are only buying as long as they are, seeing the chart as trading above that moving average. I should have taken that advice, of course. Hindsight 2020, literally 2020, 2021, 2020, these markets were beautiful. But then once it broke here, I was wrong to still be looking for buy trades. And I took a mistake and dealt with the consequences in some of this. So again, a simple 200-day moving average would have saved me a lot of losses on my account that I may or may not have had to even endure. Anyways, a simple moving average, a simple Bollinger Band, these indicators can be great. And when we are trending, you can even apply simple stuff like the RSI. I personally love the RSI signals that we can get just from trading this sort of environment. Now, I will say if I'm going to be using an RSI, I like tighter RSIs. I don't personally like the 14-day moving average. RSI. I like simple things like the 4-period RSI. I think it gives you a much quicker signal. And again, it can offer some great little quicker moves in the market that could be taken advantage of, right? So I do actually really like the shorter time frame RSI periods. And although I don't use them as my primary trading vehicle, I think they can be an excellent sort of level of confluence. For me, the next thing I want to talk about is how do I trade them? I trade predominantly with price action, and I trade on the 4-hour chart. So I'll take a look at the daily and the weekly timeframes for overall trend direction. But what I'm ultimately looking for is I am taking close note as to what market structure is looking like. So for example, if markets are, testing resistance, but then they break out, I'm looking for pullbacks and I'm looking for continuations, so on and so forth. But again, simple technical analysis like this, for example, here's a trade that I'm looking at personally myself as we make this video. It is a weekend, of course, when I'm filming this, but if markets come down to this area, I'm actually interested in buying this pullback. So that's a live current example that I am looking to take advantage of on the NASDAQ. But again, all of your traditional trend following concepts, those are things that I'm very interested in. Let me give you a con though. There are times, just like most markets do in experience, where things go range bound and it can be kind of a mess to try and trade, trend following stuff. With every strategy, there are going to be times like this. And if you don't have a filter, if you're a trend follower and you don't have a filter to try and keep you out of markets like this, it's going to be tough to make money. Because if you're trying to buy breakouts and sell breakouts here, it's going to be really, really rough. So how do you do that? Well, you can use indicators and that is an option, but personally what I look for is just market structure breakouts. I'm always paying close attention to the market structure when it comes to the indices. So when I'm looking at this range here, I want a clear, decisive break. And one trick that I found, if you've made it this far in this video, let me know. We're about 14 minutes in. If you're really serious about trading the indices, then I'm glad that you're here. One thing that I actually really like to do is I really like to actually use a Fibonacci retracement to qualify whether or not a move has truly broken out. So you might see, well, this move barely broke out and then it came right back into this range. I like to actually wait for a strong enough break that actually can give us a 38.2% retracement at this broken level of resistance. So again, we have resistance here, but again, I don't like this concept here where we just barely break out and come back. I like to see a little bit more than that. I like to see enough of a breakout that gives me something like a 38.2. Now you could maybe have found something on the lower time frames, and this might have just been a losing trade, and that's okay too. But I do like to usually see bigger, decisive breakouts. So for example, this move here, we put in a higher low, that's nice, and we got the 38.2% retracement. You can see in this case, it actually followed through very nicely. No signal, by the way, guys. Of course, I'm not trying to cherry pick and only show you winners. There are times where a breakout is just not going to work, and consolidation markets are not great for my style of trading. When I'm trend following, that is, it's very tough. So nothing works 100% of the time. But again, I'm giving you a lot of tips here in terms of how I trade the momentum of the indices to keep things in mind. Next, I'm going to show you how you can keep in touch with seasonality, which is a very important metric, I think, especially when trading the indices. Let's take a look. All right, guys, so we're taking a look now at what is called seasonality. Now, if you've never heard about seasonality, this is not necessarily a chart pattern or a inverted head and shoulders or anything like that. This is just straight market data. And this is truly, when I'm trading the indices, something that I pay attention to very, very much. This is a study. What you're seeing on your screen right now, this is essentially a study of month to month, the historical performance of the S&P 500. Now, why would this matter? Well, if you know that there are certain parts of the year where you should be more looking to be on the sell side, or more likely, or should be looking more on the long side based on historical tendencies, that can be a very powerful piece of information. So how do we read this chart? Well, again, this is the last 5 and 10-year averages here in the blue and red. And in this case, what we're looking at is we can see month to month how historically the indices have been performing. So on average, July is expected to be a positive month. Sure enough, we've been having a really positive month here according to the white line, which represents this current year's performance. Okay, same with June, same with May. Well, a little bit mixed April, but we did have a good April here. And we actually expected a slight down month, and we got that in March. So you can see how powerful seasonality can be. This year, it's been almost perfect, except for January, which was slightly negative, where we were expecting a slightly positive. But again, the point here is this is just one more toolbox to add, or one more tool to add to your toolbox. You can see in the month of August, we're expecting a rise. In the month of September, we're expecting a down month, at least according to historical tendencies. This is not a perfect prediction by any means, but it can be a powerful resource to add to your toolbox. I will leave a link down below in the description if you'd like to check out our software. This is a company-made product by my team. I own a company called A1 Trading. We build software tools for traders, and there will be a link and promo code down below in the description if you're interested in picking this up for yourself. But there is more. Of course, we can take a look at the Smart Money Tracker. The Smart Money Tracker on our software takes a look at the COT data. This is also something I heavily pay attention to when it comes to trading the indices. If we take a look at the NASDAQ, for example, this shows us the current positioning. And right now, institutional money, this is hedge funds, asset managers, money managers, that sort of thing, this is tracking their personal trades or their company's trades, right? So if they're buying the NASDAQ or shorting the NASDAQ, that's going to show up here. Again, this is required by the CFTC to be put out week to week, so it is a weekly report, and we can see their latest moves. So in the latest week, right here, this column shows us the most recent change in terms of long and short contracts. They decreased long this past week, and they increased their shorts, bringing the overall positioning to about 50-50. Now, sometimes this is not necessarily a super interesting reading. Sometimes you get more interesting reads. We also see that we can take a look here and we can actually isolate things like we can take a look at the NASDAQ right here. For example, if we want to look at NASDAQ, and we can let that data load, and we can see kind of week to week what they've been doing. So recently they had a big run up for the first couple months that we had this data in. We actually only got this feature built after this window here. Again, like I said, we developed this software and it takes us a lot of time and effort to build these tools, but this is what we have as of the most recent data. We actually see some decline in the NASDAQ in terms of positioning. That could suggest that despite the NASDAQ's run up recently, we should be a little bit more cautious looking for a bunch of trades. Now, is that the only thing I look at? No. but it may tell me that if this idea that I have doesn't work out, I probably need to get out of the way and let COT do its thing. Again, you might say, well, Nick, COT is telling you that it's 50-50 and that they sold a little bit here. Why would you be looking to long? Well, one thing that you need to know about data, if you're going to be trading with market data as we use in this software, there's a lot of things that need to be considered. And you can see right now, the indices are giving us strong readings, not just only based on COT data, not just only based on seasonal trends, but all of the metrics that you see across your screen right now. So our software basically pulls in all of these features to help us make a more complete view when trading the indices. And we can actually isolate just the indices, and you can see this is where we're at. So all the 3 indices that we referred to are currently giving us buy readings, and we can see inflation is giving us a very heavy reading. This is because the software has identified already that CPI has been on the decline and improving quite a bit, which is again taking pressure off the Federal Reserve and again making it essentially less likely to rate hike. And of course, the stock market loves that, as company conditions are going to improve in that case. So the software here is identifying all of that data. It's pulling the software in, pulling these updates in, and the software is generating buy alerts or sell alerts. If you would like I said, access to the software will be linked down below in the description. It takes me back to the chart to discuss something incredibly important to the indices. If you are trading purely technical, I think you might struggle a little bit with the indices. Although yes, the technical moves can be beautiful, you also, I think, need to pay attention to the Fed. The stock market pays hefty attention to whatever is being said by the Fed chairman or chairwoman, depending on who is sitting in the chair. Again, it pays heavy attention to what the Fed's next moves are likely to be. Are they going to raise interest rates? Are they going to cut interest rates? You need to know these things because this is what drives trends in the markets. If you're trading the indices, again, the Fed starts looking less likely to hike rates. That's what causes this run up. The Fed is raising rates aggressively. That's what caused most of this market sell-off. That plus, of course, business conditions. If you're going to be taking a look at economic figures, you got to pay attention to some of the key stuff. We can go back to the Edge Finder for a second. We can take a look at some of the economic numbers. How's GDP growth looking? In this case, not so hot. If GDP is growing, that's going to generally be good for stocks. If inflation is hot, meaning it's going to potentially make the consumer struggle, probably not good for stocks. But if it's improving, it's going to give us the opposite reading. Unemployment, how's the jobs market looking? This is a little tricky because, again, if you want to get into Fed talk, they're also watching this number because, again, inflation is directly impacted by unemployment. If people are getting jobs and raises, that's going to cause employment or inflation to spike. So you have to pay close attention to this number in reference to inflation. But at the same time, a healthy jobs market also shows that companies are strong and that consumers are going to be able to afford things. Interest rates are, of course, also something to pay attention to, whether they're rate hiking, rate cutting. That will be very important. The most recent report was a hold, which is why we currently, meaning no rate hike, no rate cut. The most recent meeting had that result, and that's why we see a 0 in all 3 of these columns. So again, the software is basically taking into account all of those things for you and generating a signal here. You could do this for free. You could read articles if you'd like, and you could open up your own spreadsheet and kind of do this by hand each day. But if you would like to automate that process, again, that is why we have built the software, as we have several people who have basically wanted this over the years, myself and Frank, who are behind kind of the design of this software. He's my trading partner. We've been doing this for a number of years together. This was a dream for us to build this, and we've invested heavily in doing so. So again, if you do want access to that software, it will be linked down below in the description. So those are my best tips for trading the indices, and I hope that this was helpful to you. If you did enjoy, make sure to hit that thumbs up. And if you made it to the very end of this video, I want you to just leave, here's your Easter egg word. If you guys could just drop the word NASDAQ in the comment section, I'll try and heart your comment as a thank you for watching all the way to the end of this video. And I do wish you well in your indices trading journey. Thanks and have a great day.
If you're looking to improve as a trader, we've got some cool free resources here that I wanted to share as we close today's video. Down below in the description, there is a link to join our Discord channel or our Telegram channel. And we also have our website, a1trading.com, where traders can get access to free course material to help you improve as a trader. Remember, we are also live Monday through Friday on this channel around 9:30 a.m. US Eastern, broadcasting most live news events and that sort of thing. So hope to see you there. And also, we do have a couple videos here showing up on the screen. If either of these seems like it might be helpful to you, then make sure to click here or here, and we'll see you there.